The labor market surprised to the upside in the latest jobs report, and combined with other data showed that a recession is nowhere in sight for now. I was concerned when the Fed let out with a big rate cut last month, thinking they were seeing something I wasn't, but things are looking much better now. In today's video, we're going to look at the latest economic data and assess what to look for in the months ahead. Let's get into it. Welcome to Real Estate Watch, the channel that focuses on forward-looking real estate analysis for the U.S. and regional markets. If you're new to the channel, my name is Eric and I'm a professional economist in addition to being a licensed real estate agent, so I can give you a unique perspective that you'll be hard-pressed to find on other YouTube channels. Today we're looking at the U.S. economy. The housing market doesn't operate in a vacuum, and broader economic trends are important to keep an eye on for assessing how they might impact the supply and demand sides of the housing market. Let's get right into the latest data. According to the Bureau of Labor Statistics, non-farm payroll employment increased by 254,000 jobs in September, which was the biggest increase since March of this year and a reversal of the slower pace of job creation we've seen recently. The positive job growth was broad-based as well, with only a few sectors posting negative job growth from August to September. Perhaps what was more important than the higher than expected job growth in this latest report was the announcement that upward revisions were made to previous months. July numbers were revised 55,000 jobs higher, and the August figures were revised 17,000 jobs higher. You may remember in recent videos that I have been concerned about the ongoing trend of downward revisions that the Bureau of Labor Statistics was making recently. So this change to now making upward revisions to previous estimates was a much welcome change of pace. It's important to remember that this was just 1 month's jobs report, and 1 month does not make a trend. So we'll want to keep a close eye on the next few jobs reports to see if these positive developments continue. It wasn't just the payroll report that is looking good. Other labor market indicators also trended favorably in the recent data. The unemployment rate dipped down to 4.1% in September, the second consecutive monthly decline. The drop in the unemployment rate happened for the right reasons too. The unemployment rate is estimated with a simple calculation. It's just the number of unemployed divided by the number of people in the labor force. You could get a lower unemployment rate if people were dropping out of the labor force, which would be a good sign, but that's not what happened. The number of employed people, which counts both payroll employees and self-employed persons, increased by 430,000, and the number of unemployed decreased by 281,000, resulting in a roughly 150,000 increase to the labor force. We're seeing a bit more slack in the labor force as well. The number of job openings in August ticked up a bit while the number of unemployed ticked down, so we're still seeing more job openings than there are people who are looking for jobs. So far, all the major labor market indicators are heading in the right direction. A recession? Nowhere in sight right now. We're getting confirmation of that from one of the world's largest banks. JP Chase has officially called it. The Fed pulled off a miracle and the infamous soft landing is here. Better than expected income for the third quarter led them to make such a bold assertion. To JP Chase, I would say this: let's not get ahead of ourselves yet. But I have to admit, the economic data is looking good. Outside of the labor market, we're seeing strong consumer spending numbers as well. The average 3-month annualized change for July and August show consumer spending on track to hit 3.3% growth in the third quarter, a strong showing so far and critical for an economy that is so reliant on consumer spending. The latest projection from the Atlanta Federal Reserve's GDP Now model put U.S. GDP on track to grow by 3.2% for the third quarter, which would be a slight acceleration of the already robust 3% growth in the second quarter. Add it all up and it's clear we're not in a recession right now and are not in any danger of entering one in the next few months. Whether the Fed has actually pulled off the miracle of a soft landing remains to be seen, but right now the U.S. economy is showing strength. This is good news for the housing market, as a recession is one of the biggest risks for a correction in home prices. Given how high home prices are right now, that might not be a bad thing for buyers who are increasingly priced out, but we'll save that discussion for my next video on the U.S. housing market. If you like this content and want to stay up to date on the latest economic and housing market data, make sure you are subscribed to this channel and hit that notification bell down below so you won't miss my next video when it comes out. And if you found this video useful or at least mildly entertaining, don't forget to hit that like button on your way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.